Ladies and gentlemen, welcome back to another episode of Investing for the Common Man, the channel where we learn how to save our most valuable resource. No, not your money, but your time with short, concise, instructional videos. Today I want to cover the topic of short selling and how it works. As I'm sure you've figured out by now, there are two sides to every trade. For you to buy an asset, someone has to sell that asset to you. Intuitively, it makes sense to buy 10 apples, and then once you have physically acquired the tasty fruit, you then have the freedom to keep them for yourself or turn around and sell them to someone else. With stocks and commodities, you typically want to buy when you expect their value to rise and sell when you expect their value to fall. But what if you expect the price of an asset to fall and want to sell it, but you currently don't own any of that asset? This is where the concept of short selling comes in. In this video, we're going to look at the specifics of how exactly this all works. Before we get started though, please do me a huge favor and support my content by taking a moment to smash that like button and subscribe to my channel. Alright, let's dive in. We started off this video with the underlying idea that there are two sides to every trade, and we have a lot of vocabulary in the market to talk about each side of the trade. We have buy and sell, bullish and bearish, as well as long and short. Long and short are a bit interesting because we use them to describe the type of position we have on an asset. If you buy 100 shares of stock XYZ on your brokerage platform, it will probably look something like this. We describe this as a long position because you have positive 100 shares, but there has to be a reason that your broker would even bother to put that positive sign there. You could sell those 100 shares, but then your position would simply be 0 shares. Sophisticated financial markets developed the system of shorting to allow traders to sell stock that they do not own, which helps equalize the buying and selling pressure in the marketplace, promoting more efficient price discovery. Short selling creates a position that benefits when the stock price drops, making this the opposite of a traditional long position by borrowing the shares and then immediately selling them on the open market in hopes of purchasing them back later at a lower price. The borrowed shares are then returned and the short seller gets to keep the difference as profit. A short position will look something like this, as if your brokerage account were holding a negative number of shares. The equal opposition of long and short positions helps to promote equilibrium in the marketplace, but short selling is a bit more complex and comes with some added risks. So let's take a closer look at the mechanics of how these trades work. First of all, to short sell a stock, you need to borrow the shares from somewhere. Your investment broker will take care of the logistics of this for you by finding another investor with the shares and borrowing them from their account for your short sale. Borrowing stock works similarly to borrowing money in that you will have to pay interest based on how much and how long you borrow it for. This interest rate can vary anywhere from an annual rate of 0.3% to as much as 20% if the shares are in short supply and considered hard to borrow. We will look at what these costs might realistically look like after our example trade. Now, theoretically, short selling a stock doesn't really cost you anything in the same way that purchasing shares does, because you are actually collecting money from the sale of these borrowed shares. But your broker will require you to set aside 50% of the value of the short position as collateral. This money remains in your account, but you will be unable to trade or withdraw it until you close your short position. If brokers did not require investors to set aside this collateral, there would be nothing to stop an account with a single dollar of capital from shorting hundreds of thousands of dollars worth of stock. One important thing to note is that since a short seller only has to put up half the value of the stock as collateral, that technically makes short selling a leveraged position, and we will see how that leverage works in our example. So let's say for our hypothetical scenario, investor A is extremely bearish on stock XYZ that is currently trading for $10 per share. So he decides to short 100 shares. Investor B has a different outlook and is bullish on the stock, so he purchases those 100 shares for a total of $1,000. Now remember, investor A's capital requirement for short selling is only half of the value of the stock, so investor A's cost basis for this position is only $500. Now let's take a look at the potential outcomes of these positions. For a traditional long stock position, the maximum loss, while incredibly unlikely, is 100% of the initial investment if the stock goes all the way to $0 per share and the company goes bankrupt. In this scenario, that maximum loss is $1,000. On the other hand, the maximum potential gain for a long position is technically infinite because there is no limit to how high a stock price can go. On the short side of this trade, the risk-reward ratio is flipped. Investor A's max gain is $1,000 if the stock goes all the way to zero, but his max loss is technically infinite. This unbalanced risk-reward ratio should already give you an idea of how risky short selling can be, so one should always use extreme caution when considering a short position. Maximum possible loss and maximum gain scenarios are incredibly rare in stock positions, so let's look at a couple more realistic scenarios. If stock XYZ decreases in value to $8 per share, then investor A would gain $200 and investor B would lose $200. This dollar gain and loss are equal and opposite, but if we consider each investor's initial capital requirement, investor B experienced a loss of 20% on their investment, but the short seller gained 40% on his investment because his initial capital requirement was only half of the original value of the borrowed stock. If the stock were to instead increase in value from $10 to $12 per share, then the short seller would lose $200, equating to a 40% loss on his position, while investor B gains $200 or 20% of his position. This is where we can see how the leverage of short positions can magnify both losses and gains. In addition to the added leverage risk, time is also working against the short seller. Beside the fact that stocks generally tend to go up over time with economic growth, the short seller also has the added expense of interest on the borrowed securities every day until the position is covered and the borrowed stock is returned. If the stock is easy to borrow, the interest rate could be as low as 0.3%, which in this example would work out to less than 1 penny per day for $1,000 worth of stock. But if it becomes hard to borrow, that rate could increase at any time. If the rate was as high as 20%, then the daily interest payments would increase to 55 cents per day. These interest fees may seem small, but they can add up very quickly with larger position sizes that are kept open for multiple days or weeks. For example, a larger position like shorting 100 shares of Tesla worth about $100,000 over 5 days at 20% would accrue about $275 in interest fees. The final risk involved in short selling that you need to be aware of is that the broker lending your shares theoretically has the right to recall those shares at any time and force you to cover your position, realizing a loss. This is rare because large brokerage companies have vast supplies of shares and prefer to avoid recalling stock because it may encourage customers to seek out a different broker. In most situations when recalls do occur, it is because the trade is moving against the short seller, and the broker wants to avoid the risk of the short seller never being able to return the shares. This can force the short investor to realize a loss, even if they still believe that the stock will eventually crash. From what we have learned today, you can probably tell that short selling is an advanced trading strategy that, while at times may be lucrative, carries a lot of risk. I personally use this strategy very rarely, but regardless, it is important to understand how short selling works because you will often see price action affected significantly by short sellers. If we look at the chart of Tesla, we can see several examples of a short squeeze when the stock began to rally, and then short sellers were forced to cover their positions, which initiated a chain reaction of short covering to create these violent spikes in share price. In my next video, I want to continue with this topic of short positions, but in the context of options, which function quite differently than short stock positions. If you learned something today, please hit that like button and consider subscribing to my channel for more educational content. Let me know if you have any questions about this topic in the comments below. Until next time, keep calm, stay healthy, and happy trading.